I'm Keith McCullough, and welcome back for another real conversation. I get to have a pro-to-pro conversation with one of the most experienced global macro strategists out there, a friend, a guy that I look up to in a lot of ways. If I could only ride those bikes as fast as the Dutchman could, I might even have a little less chubby cheeks, Jurrien. But thank you for making the time today. I appreciate it.
Happy to be here. Thanks, Keith. Nice to see you.
Yeah, I do think experience matters. I know. Some may quibble with that. I do see a lot of behavior that's very, I'd call it episodic and non-trending until you get an education from a cycle, right? So pardon the pun with your cycles behind you. You've been doing this for over 35 years. I've been doing it for over 25 years. We've seen a lot of cycles. And I just want to start with that. The short-termism of it all, fully loaded with whatever clickbait we're going to get today on the Fed or Trump tariffs. What do you think about that within the context of both your career and just studying cycles themselves?
Yeah, no, it's a great observation. And I've been in the business 40 years, 30 at Fidelity and 10 on a bond desk in New York on Wall Street during the 80s, the dark ages. And so I've been, I think, through 12 bear market cycles, and you learn from them. I mean, if you assume that market behavior is a subset of human behavior, and that while history may not repeat, it certainly does rhyme because people tend to do the same, stupid shit all over, over and over again. And so you learn from them, and after all these cycles, I can't. It's hard to get fazed by things anymore, and so. The market has always come back from the abyss. Sometimes it takes a long time. Sometimes it takes a short time. But the markets are going to do what they're going to do, and there's a clearing price for everything. And the starting point obviously matters. So if you start something from a high PE, you might have further to go. But you just kind of learn to take it in context. And that comes with experience. And so, if you're a young trader out there, like there's no way to fast track that other than by doing it. But keeping those types of things in mind, that these are cycles and they are reflections of human behavior, of fear and greed, and all of those things, and just kind of take a step back, look at some charts, of course, which you and I both do, and the charts don't lie, and they can be very helpful in terms of providing some sort of narrative and context, so that we don't get lost in the shuffle of short-term sound bites and panic or euphoria.
Yeah, I've always loved that about our conversations, both in person when I'm in Boston or otherwise like this. You're always pulling it back, right? You're always like, okay, I heard you on that. Let me compute that in the time series that's in my brain, which is, again, you got to keep looking at this. There's a deliberate study to it. I mean, there's a deliberate nature to cycling, to risk managing cycles. To pretty much anything that matters. So I really do like when you think about it, though, now, the market, well, first of all, this is one of the fastest, what we would call a quad 4 crash or a 20% or more decline in U.S. equities, but it's also one of the fastest recoveries. So again, that short-termism applies. But most recently you wrote about finding the put or finding the strike price for both the stock and the bond market. I thought that was very good. Can you recap what you think on both?
Yeah, and so the way I think about it is, the market's always in price discovery mode, right? I mean, the market never sleeps. And one of the things to remember, for maybe if some of your viewers are are longer term investors who are trying to adjust their portfolio when things change, one thing to remember is that the market always reprices faster than we can. And of course, you have a very robust, outstanding system that you can kind of stay ahead of that. But for the average person without an edge like what you have, it's very hard to outsmart the market, because it's going to reprice a lot faster. And so, efficient market hypothesis is that Market's not always right, but it is always incorporating new information, and whether that new information is then going to change or not is another question. And for this market cycle, I don't want to quite call it a bear market yet, because we kind of went down 21.5% and came back fairly quickly. So it's sort of a near bear or a bear scare, but it may turn into a bear. Who knows, of course. But one of the things that happens in price discovery is that the market tries to find its boundaries, its sort of its pain points, if you will. And I think of it as, if you have a store and you're selling bicycles, right, and nobody's showing up to buy bikes, you're going to put them 10% off. You're going to put them on sale, and then you see who shows up. And for the markets, it's kind of the same thing, right? So a few months ago, markets were priced for perfection, the whole animal spirits thing after the election. And the hope was that the tariffs were a means to an end, and maybe they still are, who knows. But there was no pricing in for any kind of downside risk to growth. Then that changed in February, and then the market went on sale, down 10%. And that seemed to be enough for a while. And then then the kind of the April 2nd and then April 8th rhetoric came out that was a lot more hostile than I think people were hoping for. And then we went down 20%, and that was the 20% off sale. And so that's a repricing, and then you see who shows up. And of course, at that point, the administration started walking back some of the more hostile rhetoric. And it started with the bond market, right? We had that basis trade unwind, and the yield on the 10-year jumped like 60 basis points in a matter of days. That got the attention of the Treasury Secretary, and therefore to the president. And then, a few days later, we had that swoon in the stock market, and that got the attention. And so this is where the market puts come in. So in the past, we would rely on the Fed, or rely on the Fed is a big word, but it would be the Fed that might, pivot. Like in 2018, that's exactly what happened. We were down 20%. That was a bear scare as well. And we had the Powell pivot. And that then launched a huge rally in 2019. And by the way, the analog looks a lot like that 2018 swoon right now. And so we don't have the Fed to rely on right yet, or at least not yet, because Powell is sort of stuck in the middle here between calls from the president to cut rates, and is he going to take the bait? Probably not. And also, we don't know how inflationary a trade war might be. So the Fed is not where the put is coming from. And the fear, of course, even just a few weeks ago, was that the put wasn't going to come from the White House, because the White House has said, we only care about bond yields this time. Last time we cared about the Dow Jones Industrials. This time we only care about bond yields. And then, of course, when bond yields started to get unanchored, that did prompt a response. And then now we also know that a very large decline in the stock market, down 20% from the highs, also got the attention. So this time the put is coming from kind of the more fiscal side rather than the monetary side. And it doesn't matter where it comes from as long as it's there. And again, that's part of that price discovery, is finding where those internal circuit breakers are in the market, and that then makes the market smarter. It's like a machine learning thing. Now the market knows where those points are, and those points now become support levels, and so that's how we kind of create the goalposts, if you will, for this cycle, and whether the 20% was all we're going to get, or whether this is just a retracement rally on the way to deeper lows, or maybe this is going to be a long trading range. I kind of suspect it might be the latter, but that doesn't matter. But this is part of the price discovery of the markets. And with every day, the market gets a little smarter, because we now have another day of trading history behind us that kind of helps set the boundaries for where the buyers come in and where the sellers come out.
Excellent context. Again, if you were to ask most people like how they feel or think about the stock market, first of all, we rarely, if ever, start with our feelings. But from a process perspective, I thought that was very good, because you essentially go from, what 2018 is a very good example. The Powell put, it was more so, I called it poopy in the Powell pants in the fourth quarter of 18, because he was kind of a rookie on the job and eventually had to turn tail to dovish. But that's a 20% decline. So is this one. Now I think, I mean, in my vernacular, I guess I'd call what you just said the pump put. I called Trump pump. So anyway, pump. When he needs to, he can tweet, he can say something, he can do something, he can, he can wave at boats, he can do whatever he wants. I mean, the market seems to be ready for now to trade that short term, despite what they got upset about, which is the long term. I mean, that's really, for me, Jurrien, the thing that I'm struggling with. Like tomorrow, I'm going to have to try to explain this with like 150 slide deck, that like, there is a causal factor to operating margins for companies and to the earnings growth rates of all these companies that had bubble multiples and those that are just cyclical that are going to be impacted by tariffs. I mean, that is, to me, at least a top 3 causal factor. And unless you think that the tariffs are going away, I mean, I'm more focused on 900 days from now for companies and their corporate profit cycle than I am the next 90 minutes, even though, it's kind of odd coming from me because I trade every 90 minutes. But I mean, it's still, I have to think about both things at the same time.
Yeah, no, you raise a very good point. And let me just start by saying one of the dynamics that is hard to game here in the administration is that, and I'm not a political expert, but it seems to be that different voices within the administration are listened to at different times, and some are maybe more extreme and some are more moderate. And depending on what the president says, you can kind of sense who he's been talking to. And so if it comes from certain corners who are more, tariff focused, no matter what the consequences are to the stock market, that tends to have a more negative impact on the markets. And then he probably gets a call from the other side of the street saying, Mr. President, you can do this. And then they get walked back. And so I'm trying to actually do like a Google search of whose name comes up more often, whether it's Besant or Navarro, and maybe there's like a trading algorithm that we can create that if one side goes too much to a trend deviation, maybe it's time to take the other side. So maybe that could become like a VIX trade or something. But to the larger point you raised, the stakes seem to be very high right now because we have the cyclical, right? So we had a bull market start in October 2022 after a 28% decline. That was all driven by rates. There was no recession. Earnings actually grew during that time. The median bull market is 30 months. The median bull market age is 30 months and 90% in gains. And we did 30 months and 76%. And so we're like right at that age where you want to start looking for the cycle to turn. Now, the median, of course, is misleading because you have cycles that are much longer and you have cycles that are much shorter. But it's a place to start looking. And then we have the secular context, right? By my math, and I know other technicians will not agree with this, but by my math, the current secular regime started in 2009 after the financial crisis. That was the whole era of financial repression, financial engineering, share buybacks, dominance of the mega growers, which later became the Mag 7. Higher operating margins, lower interest rates, lower taxes, et cetera, et cetera. The typical secular bull market, not that there is a typical one because there's only been a few of them in history, but you're looking at an 18-year period of well above average returns. So by my math, we're at year 16, right? So we're like in the 8th inning of the secular bull, as well as maybe the 9th inning of the cyclical bull. So you start putting those things together and you're like, okay, now we have a potential catalyst for a regime change, right? If this tariff stuff is for real, and it certainly seems to be, and if the White House is trying to create a whole new world order, basically, right, where the vendor financing of the Bretton Woods Part 2 system of us sending our dollars overseas to buy stuff or to have stuff made, and then those dollars get recycled back into the U.S. in the form of treasuries or equities or FDI. If that starts to unwind, then you have a sort of the end of the dollar dominance era. And what does that mean, right? So these are really big existential questions, and we only get to live through a couple of secular trends, in our career because they span such a long time. So the questions are very important. And you mentioned margins. Operating margins are perfectly correlated to PE ratios for obvious reasons, right? I mean, if you have a company that has a high margin and strong free cash flow generation, it's gonna command a higher multiple, which makes perfect sense. But so all of these things are kind of at generational highs. The CAPE ratio, was in the 30s at the top. It's now in the 20s. So these are big questions, and we don't really know the answer because we don't know whether the market can continue to push policy back in between the goalposts, or whether at some point, these policies will happen no matter what. And so it's a good time to be asking these questions.
Yeah, if we can put all that, I'm going to try something with you here that I've never tried before, but that's okay. I'll try to put this in the context of Jurrien Timmer's career, okay? So let's go, guys, go to slide 57 and show the U.S. corporate profit cycle. This actually goes well beyond that. It goes back to 1970. I'm not trying to make you a 100-year-old man here, Jurrien, not yet. But if you go back to like the rate of change of profit growth, okay? Coming out of the 1980 recession, profits accelerated. Stock market went all the way up, then collapsed in 1987, as you well know. Then profits re-accelerated. These are mini profit cycles compared to the mother of all profit cycles we've seen in a pre-tariff period, right? Like, so then you get post, tariffs, or or I should say, with the tariff policy that's trying to be unwound here. And again, like coming out of 2000, profit cycle just ripped all the way till 2007. Profit cycle bottoms in 08, rips all the way till 2015. 2015 is when gold bottomed, by the way. 2018 you mentioned, profit cycle from there only go up. And now, unlike the other profit cycles you're in, you're at the all-time high, right? All-time is a long time. I mean, there used to be cyclicality. Actually, if you look at that, if you just consider my and your career, if you kind of like consider the pre-tariff world, there was much more cyclicality to earnings, and they were from much lower operating margins.
Yeah, and so you perfectly describe the cyclical versus the secular, right? So
right.
These margins go in cycles, of course. In recessions, margins go down, expansions, they go up. But beyond that, you have these super cycles, and this one that you just described has been underway now for almost 2 decades, where it makes higher highs and higher lows, right?
That's what you're saying. Sorry to interrupt, but you're saying that's when you say some. I mean, technical analysts, it doesn't matter. You're a macro strategist that understands charts. Big difference. You're not just like putting a 50-day moving monkey on this thing. I mean, you said that's why you say it started in 09, correct?
Yes.
Because it's just like the mother of all profit cycles. Many could argue that's perpetuated by easy money, deficit spending. There's plenty of reasons for that.
Yeah, I mean, it's interest rates, it's taxes, it's margins, it's financial engineering, right? Share buybacks, right. M&A. I mean, if you go back to 09, just to give you a little trivia, and you count up all the IPOs and secondary, so all the issuance of shares, it's about 3 trillion. And if you add up all the retiring of shares through buybacks or M&A, it's about 25 trillion. So you have an almost 10-to-1 imbalance of the internal demand for shares versus the supply of shares. I mean, if that doesn't make a difference in producing an outsized return, then I don't know what will. And so that is the secular context, right? And this is why it's important to kind of take that step back. And so, if we have a changing world order, if that actually happens, and we have fewer dollars coming back into our assets, and we have maybe the end of the U.S. dollar exceptionalism. I mean, I'm always skeptical in saying that, because this whole world reserve currency thing has been talked about for a long time. But let's say that actually starts to happen, then you would imagine margins will come down. and maybe inflation comes down, so you get into some sort of a stagflationary era. And if that's the case, that whole U.S. exceptionalism trade might be cresting. I don't think it's going to crash, but it might be cresting. And then you wonder what kind of PE should those companies be trading at, right?
Right.
And the U.S. At the peak recently was trading at a 68% premium to the rest of the world. Now it's down to 50%. But that's still very high. And PE differences can stay in effect for a long time if there's not a catalyst to change to change that. And the catalyst would have to be earnings and margins and payout ratios and things like that. And so we actually now have a moment where you could actually say, okay, there's the catalyst. A changing world order would certainly be a catalyst. And right now, and all of a sudden, you have the earnings estimates for EFI, for the non-US developed markets, are growing at 10% and rising, and the earnings estimates for the US, for the S&P, are 10% and falling. So you're
Right.
actually finally getting an inflection point where that mean reversion trade of US versus international that everybody jumped on way too early, including ourselves, maybe that moment is now finally getting here. And that's obviously a risk, but it's also a tremendous opportunity.
Yeah, I mean, and you and I, that's why we get along. The answer is generally maybe and maybe not. I mean, because we have to, behave like good Bayesian boys and take the next data point. There's plenty of things that can obviously happen, but again,
Yeah, and remember, there are no easy answers, right? The investing or markets is like a four-dimensional puzzle that can never be solved. So all we can do is try to have an edge. And of course, you have a system that gives you an edge. I think I have a system that gives me an edge. But it's never going to be that obvious. And if it ever is that obvious, maybe it's time to take the other side of the trade.
Yeah, the only thing that is obvious to me on that, and if we zoom into the chart now, at the same chart, but zoom in, guys, the next slide, you can, what I do know with 100% certainty, Jurrien, is that on the right side, so if we just zoom in to not your entire career, sorry to do that to both you and I, because I've been doing it for 25 years. But again, if you just think about the rates of change of corporate profit growth, the two most expensive markets in the modern era came in 2021 and at the end of 2024, when the rate of change of profit growth went to the all-time highs. The prior all-time high was 2021. Then stocks crashed in 2022, to your point. And, whammo, we're at an even higher high. So, I like to say ever is a very long time, especially when you think about mean reversions in macro. And I don't really know if it's mathematically impossible it's possible for companies, and maybe that's part of the story in earnings season so far, is that they're reporting yesterday's news. They're not reporting the 900 days from now news in a post-tariff world. But that is a undeniable fact, that the most expensive part of the market, which let's get into that too, because I'm sure that's can be part of how you comment on this, but you can't have those peaks unless you have the all-time highs in growth rates of both revenue growth rates and commensurate cash flow growth rates for the Mag 7, which I now affectionately call the Bag 6.
Yeah, no, agreed. And when we think about, so, my colleagues and I in the asset allocation department at Fidelity, and you've presented to us many times, but when we think about US versus non-US, so US versus EFA versus EM, it really is just a question of Mag 7, right? Because the US
Right.
versus non-US is essentially the big growers in the US, which is the Mag 7. And so that whole global rotation trade, small versus large, growth versus value, US versus non-US, all comes down to 7 stocks, basically. And and that's a little scary, right? And if you look at
A little.
But if you look at past periods of sort of what I call Nifty 50 dominance, right? So we had the Nifty 50 period in the early 70s, which is, we had a retail bubble in '68 when all the space stocks and all the electronic stocks, kind of went to feverish highs. Think of it as like the meme frenzy back then. Back then, any company with the word tronics in it was trading at a 50 multiple, even if they had nothing to do with electronics. Then we had kind of that retail wipeout, 69.70. That was a recession. Market fell like 37% or something like that. Then it recovered, and we made a new high in January 73. But by then, the market was really in the hands of institutional investors because the retail was wiped out, and those institutions only wanted to buy the IBMs and the Xerox and the Colgates, the blue chips, and we call them the Nifty 50 stocks, and those ended up trading at nosebleed valuations. They were trading at 2 times the PE of the rest of the market, of the bottom 450. And then inflation killed valuations across the board, which is what inflation does. It destroys valuation for anything. And then we had another Nifty 50 boom, of course, during the dot-com era in the late 90s. Again, those what I used to call them the Janus 20 stocks, because there was a Janus 20 fund that just had those Mo stocks in them. Those stocks ended up trading at a 2x multiple. So these were like the Ciscos and the Dells and things like that. That became a valuation bubble that imploded just on its own weight, under its own weight. So that was not an inflation episode, but just a valuation bubble, pure and simple. And so now we have the third Nifty 50 or Nifty 7. And the one big difference is that this time the performance has been much more justified by earnings. So the relative PE, instead of being at a 2x, is only at a 1.3x. And so that does give me some comfort that this is not going to be like a 2001 or a 1974, but that it'll be a little bit milder. But having said that, history clearly shows that when you have a very large concentration of a few stocks like we do now, if those stocks go down, the market goes down. And that, I think, is another question that we need to think about, in not only in the coming months, but the coming years, is that if we do have a rotation out of the Mag 7 into everything else, that rotation can be kind of benign, right? Meaning that other stocks just go up more and the Nifty 50 or the Mag 7 just sort of like meander. That would be a very glass half full outcome, because then the rising tide lifts all boats, and the S&P 500 equal weighted or the bottom 493 can do well and not be at the expense of the market. But if it's a rotation that's more of a zero-sum kind of rotation, meaning the Mag 7 gets sold and people and investors are buying, EFI or EM or the banks or what have you, if those Mag 7 go down, the market's going to go down, because those Mag 7 are a third of the market. There's just no mathematical way around that. And then we get into this really larger philosophical question that if the secular trend is turning from secular bull to something in between secular bull and secular bear, what does that look like, right? So we know we have the alpha and we have the beta, right? The beta is the market return. The alpha is the excess return that we get from buying the right stocks or staying out of the wrong stocks, or rotating between sectors or asset classes. And the last couple of decades, of course, there was a lot of beta, right? The 60-40 paradigm was 60% S&P, 40% U.S. Ag. That produced a 9% CAGR with a 9% vol. I mean, like, what's not to like there, right? You didn't have to you didn't have to buy anything else. You didn't have to try to outsmart anything, because that was a really good source of beta. If that is going to change because the secular bull is cresting and the bond market is just not doing what it used to be, which is to offer good returns while also adding a diversifier effect, then we are probably going to have a lot less beta, not negative beta, but just maybe mid-single digits or low single digits. And then we're going to have to get much more out of the alpha side. So like your system would add a lot more return as a number of basis points of the total return than a high beta environment would. And so that will make being in the right places and avoiding the wrong places much more important than it has been in the past, because mistakes can be easily forgiven if your baseline is a 10% return. But if your baseline is a 4% return, mistakes will add up a lot more. And so that's kind of how I'm thinking about the Mag 7 and the bigger picture if we are truly cresting the secular wave.
Yeah, that's a classic lesson of long-term cycles. Is that you look at the trailing returns and you expect that in the future. And we're not talking 10, we're talking north of 20 back to back, right? And when you think about the earnings growth rates that perpetuated it. So for me, even if I tear apart, which I started calling the Bag 7 in February, like how I am, I have to get attention of guys like you and gals that you work with, et cetera, like with the titles of my notes. But it really did apply. I mean, you're bag holding the same thing as most people who have a 60-40 portfolio that has the 60 in stocks. So and if I look at why I call it Bag 6 now, I mean, what's the differentiator between Microsoft, which is not bearish trend? It's because they actually showed the revenue and earnings growth rate that the other ones didn't. So I mean, it's not to say that God didn't write it in the sand that says that all 7 of these stocks have to go up or down together. Currently, there is differentiation with Microsoft in particular. So there's that, but there's also just the aggregate, because you're saying, correct me if I'm wrong, because I'm just trying to remember what you wrote in your recent notes, but you have the earnings growth rate, which was in the fourth quarter like 11.5% or 12% for the S&P 500. You're currently running around that, with 2/3 plus companies having reported in the first quarter, so you're still hanging in. You're still saying there's a chance, but you have it dropping by like 300, 400, 500 basis points, like from there?
Yeah, so I track obviously earnings carefully. I look at revisions. I look at the quarterly earnings season, and what always happens, and you know this better than anyone, is that the numbers, the estimates come down in, let's say, the 9 months leading up to this the reporting season. Companies like to underpromise and overdeliver. And they get the pat on the back for beating estimates. And then during earnings season, like at the start of earnings season, the numbers are at the lowest point. So I'm talking about the growth rates, the expected growth rates. And then lo and behold, companies beat earnings, and the numbers jump by 300, 400, 500 basis points, which is exactly what is happening for Q1. It's been a very good season, and Q4 was very good as well. But of course, as you point out, that's in the rearview mirror, because those numbers don't reflect any uncertainties about tariffs and the state of the economy. And so what is happening is that the Q2, Q3, Q4 numbers are all being marked down, which makes a lot of sense, right? Because if companies are if they don't know what the rules of the road are for tariffs, they're probably sitting on their hands waiting for some clarity. That means they're not going to spend as much money. Some of the consumer spending numbers are down a little bit. You saw the airlines are warning, and so it makes sense that the numbers come down, and the GDP estimates have come down as well, right? So Bloomberg has the surveys, and so that all makes sense, and the market is okay with that, right? At down 20%, and we're not down 20 anymore, but at down 20%. The PE on the S&P had gone from 22 to 18. From the Mag 7, it went from the high 30s to the mid 20s. So a pretty good concession, which is good. Like, you want to see that, because you don't want the market to be priced over its skis when things get more uncertain. And so the market has the PE came down in anticipation of the E coming down, and the E is coming down, but it's still remaining in kind of a growth slowdown mode as opposed to a recession mode. So the market is better priced than it was, but it's still only priced for a growth slowdown. And I don't know if we're going to have a recession. Certainly the coincident indicators don't suggest it, or the only thing that suggests are the kind of the soft data, as we call it, surveys and things like that. But if that were to change and we did actually get a recession, then the numbers are too high, and then we need more of a haircut on the PE side to accommodate that. And I think that's the line in the sand that the market is now grappling with. And we're kind of back in the middle of the range. Maybe we go back to the highs, maybe we don't. Maybe this is a deep wave 2 or something. But that, I think, becomes the call here, saying, are we just going to have some uncertainty and some slowdown? And we know that there are pain points in the market where the president and his staff will walk back whatever rhetoric is causing the pain in the first place. But if we get a recession, then the earnings are too high, probably.
Yeah, I find that fascinating. The fascinating yet predictable. Fascinating that it continues to be predictable, I guess. I mean, it's kind of sad, really, to watch. Like, it's one thing to know nothing, which I still don't know anything, but I mean, in my first 5 to 10 years, what did I really know about, what strategist was saying and when? But, after 25, going in your case, 35 to 40 years, you see that people come after not calling any of this risk, right? Just like completely, in some cases, willfully blind to it at the end of January into February, to now, well, that's because it's going to be a recession. Now they're, okay, you didn't warn me about a recession, but now you're sure it's a recession. I mean, it's like finding Waldo, right? I mean, it's completely useless is what it is. Because what we know, you just pointed this out. I mean, in 2022, we didn't have a reported recession. Stocks still crashed. In 2021, you could barely see the recession. I mean, it was de minimis relative to any historical recession. And again, there's a difference between unwinding bubbles that are premised and prefaced and perpetuated by revenue and earnings growth rates that slow and a recession. There's two different things. It's not to say that one isn't tethered, explicitly to the other.
And that is the difference between a garden variety bear market and a super bear market, right? So if you take a financial crisis, you take the dot-com bubble, you had a coincident decline in earnings and in the PE, right? Like that is a devastating combination, because you think about the math of the PE, right? Price over earnings. If earnings are going down and the price to earnings ratio is going down, then think about how much the price has to go down. Like, it has to do like a double duty to keep up with the math. But you have more garden variety bear markets, and 2022 didn't see any earnings decline. It was all the PE and not the E. But like COVID, that was all E, and of course the PE declines as well, but it declines before the E declines, because it's just anticipating that. And then when the market sees the light at the end of the tunnel, the P or the PE goes up, even though the E is still falling. And again, this is another warning against trying to outsmart the markets too much, because the P and the E rarely move at the same time, right? The market's always discounting the future, not always correctly, but it's always discounting. And so like in 2000, the market, crashed 35%, and it made the low in late March. And by June, it was at an all-time high. And a lot of people just, were like, people are still dying. Like, how can you possibly be buying now? And the markets were just doing what the markets always do, and that is anticipate. And so for the current context, it will matter if this is a bear market, which I don't know yet if it will be, but whether it's a coincident decline in the valuation and in the earnings. And if that happens, this could be an outsized bear. And the fact that we're starting from a high PE level obviously always has to enter the mind, because starting points do matter.
Yeah, and we've spent, when we're talking market, what a lot of people care on, if not most, only care on, is the stock market, U.S. stock market. I mean, there's no debate on whether or not gold is in a raging bull market, okay? Like, if you can't see that, you're certifiably blind or completely new to this, right? I mean, and to a lot of people, like, let's get back to the point you made on 60/40, because you've written about this recently too. I mean, your name's Jurrien Timmer, and you do global macro, so you can go anywhere with your hard-earned capital, and so can I, so can my family, so can our community. And if you went to gold, you just crushed it, right? I mean, if you can't find the P and the E, you find the gold. That's what the market just told you, right? Like, you better find some in your portfolio, or you're gonna really certainly lag the type of return that I was able to generate. And then there's that other thing called Bitcoin that hasn't gone away, right? I mean, they're not the same. Gold's not Bitcoin. Bitcoin's not gold. You and I agree on that. But first on, like, is there anything that gold is telling you that doesn't say that we're not that multiple compression isn't here to stay for at least those formerly known Mag 7?
Yes, so you raised some really good points, and that brings me back to my earlier point about the beta and the alpha, right? So the days of just owning some 60 and some 40 and calling it a day, I think those days are behind us. They ended in 2022. And so now, in my sense, we have to paint a diversified portfolio with a much broader brush. than saying, okay, S&P and Barclays Ag or Bloomberg Ag, as it's now called. We have to go further than that because we have to de-emphasize the beta and emphasize the alpha. And what I found is that when you think about 60/40, the reason we've always had the 40 in there was to protect against the 60 coming down. Well, now bonds are positively correlated to equities. So the 40, there is value in the 40, right? Real rates are positive. So you are getting paid to own bonds, but they are not really protecting anymore. And so what do we do with that? And I have found that over the past 100 years, which covers a long period when gold was not even tradable, but when bonds do well, then obviously you just have to own bonds as the 40. You don't have to look any further. But when bonds don't do well, gold is the hedge against that 40, right? So I don't see gold. It's a hedge against the 60, but I see it more as a hedge against the 40. And by that and by saying that, I'm trying to be clever because obviously, if the 40 is not doing well, meaning bond yields are going up, and if bonds are correlated with stocks, that means that stocks are going to do poorly when bonds do poorly. And so in that case, gold is going to do well as it is now, and so by extension, gold really is a hedge against both the 40 and the 60. But the price action in recent months has been very telling because when we had that big swoon back in March in the markets, stock market was down, the bond market was down, the dollar was down, all at the same time. Rarely does that happen because usually when risk markets are tanking, the dollar is bid because it's the global funding currency and everybody just wants those dollars because that's liquidity. That has not happened this time, and it's almost like the entire U.S. market is on sale, right? Stocks are on sale, bonds are on sale, the dollar is on sale. And so what does well in that scenario? It's gold. And gold is, obviously a store of value. It's the anti-dollar, and there are geopolitical repercussions of is the dollar going to be have a reduced role as a global reserve currency, and are the Chinese and Russian central banks hoarding gold now? I mean, there's all kinds of other elements at play. But gold is an interesting asset because it changes its stripes sometimes. We know what it is. But, for years, gold were completely locked in with real rates. So, right, if you take the TIPS real yield, gold would do the opposite. And that whole pattern fell apart a few years ago. And now it's doing something else. And it makes it fascinating. But again, it's that beta versus alpha, having more building blocks in a portfolio other than just the 60 and the 40, right? Cash is now compelling. You can put tips in there. You can put in like liquid alts, like managed futures or hedged equity, right? Strategies that de-emphasize the beta and emphasize the alpha. And gold, surely, I think, plays a valuable role as the anti-bond, if you will. And if bonds are going to be an impaired asset class to some degree, meaning the term premium is going to have to go up because we're going to be spending a lot of money that we may not be able to finance so easily anymore, especially if those dollars don't get recycled back into our markets. And so gold to me becomes one of the anchors. And then, of course, as you mentioned, you start talking about Bitcoin. I went down the Bitcoin rabbit hole 5 years ago, and it's just such a fascinating market. If there was ever an asset class where there are so many strongly held yet poorly formed opinions, you just have to go onto Twitter to take a look at that. It's fascinating, and one of the reasons I got involved with the space as a TradFi 60/40 person was to just look at that from the lens of a normal traditional investor rather than a crypto native, right? And so to me, gold is gold. It's always going to be gold. It's always has been gold. It's one thing, and that one thing is a store of value, a hard currency. Bitcoin, of course, is trying to be like gold, or exponential gold, as I call it. But it's also like the NASDAQ at certain points, right? So I liken Bitcoin as Dr. Jekyll and Mr. Hyde, because you never quite know which Bitcoin is going to show up to the party. Like you always know which gold is going to show up because there's only one gold. But in the last few months, of course, we've had gold, soar to new highs while Bitcoin was in a correction because it was being the Nasdaq instead of being gold at that point. And now I think maybe a baton pass will happen because the Sharpe ratio for gold is way up there, and for Bitcoin it's negative. So maybe this is just two different players on the same team taking turns, which is not a bad way to think about it. And actually, gold and Bitcoin have a negative correlation to each other, which is kind of ironic if they're trying to be on the same team. So that's how I look at it. And the way I think about it is, Bitcoin, of course, crushes gold on a relative performance basis over the last 10 years. But that to me is not a fair way of looking at it. So because the volatility levels are so different, Bitcoin has like a 70 vol and gold is a quarter of that. So I like to look at it as a 4-to-1 ratio, right? If I'm going to have 5% of my portfolio, and that's not investment advice, but let's say I'm going to have 5% in the store value camp, then 4 would be gold, 1 would be Bitcoin. And if it's 10%, it would be 8 gold, 2 Bitcoin. Again, not investment advice, but that's the way I would start to think about it. And then you're equalizing the vol levels of the two, and they become very compatible in that way. And so that's kind of how I think about these alternative asset classes of gold, Bitcoin, and other building blocks that we can sprinkle into that 60 or like a 50, 20, 30. And I think that might be the recipe going forward.
Well, I like, even though you said it's not investment advice, that's been my investment advice. So I'm actually at 8% gold today, GLD plus physical, and 2% Bitcoin. But last week, I was at 12% gold and 0 Bitcoin. I just finally bought my Bitcoin back. What's interesting about Bitcoin, notwithstanding, first of all, they take turns. Like you said, I like that. Same team, different players. I mean, just look at we got to wrap up here soon, but the inverse correlation table that I show every morning on a trending basis, like 3 months or more, which most investors are focused on, Bitcoin has a positive correlation to the dollar. In other words, it collapsed alongside the dollar. And gold's been the best place to be as a negative dollar bet by far. Actually, the best ever across durations, across relative to itself or relative to any other asset class. So, but there is a fighting chance here. For actually, the market signal from my signaling perspective would say that it's not just a fighting chance. Bitcoin's back to being along, where it can do its own thing. I mean, it's not like there's credibility in the American currency when every day is a new tweet or a new note from Pump. Or at one point, Pump yesterday was telling the new Canadian Prime Minister that he's an artist, and when he looks at the Canadian, the line on the map between the USA and Canada, that it's just he sees something different. Like, I mean, if you're Canadian or if you're Dutch, in your case, I think you were raised in Aruba, or if you're from Aruba, if you're from anywhere other than the USA. And some dude every day gets up and gives you this very technical signal. The President of the United States gave the world a very technical signal. It looks like this. Yeah. And that signal was like, buy gold. At some point, I think now, buy Bitcoin. We consider it, again, not crypto. We consider it its own, own commodity within a major digital assets class. I mean, we're long euros. I mean, I'm long the Swiss franc. I mean, I've never been long these things. I mean, these things even have credibility relative to that.
Yeah. No, absolutely. And so if you look at gold, right, you watch the global money supply growth rate, you watch real rates, and when those are moving in the right direction, you want to own gold. I mean, for other reasons as well, the dollar obviously being one of them. For Bitcoin, it's the global money supply and S&P 500 rate of change or NASDAQ rate of change. So if you get equity beta to be positive and the money supply is growing, Bitcoin's going to be on fire. And that I think is the change over the last few weeks till now. And so, yeah, I do see them as different players on the same team. And to your point about the middle finger, I was in Holland just a few weeks ago at my parents' house, and people there are just rolling their eyes. All the talk shows are like, what did he say this time? And it's sad to see, right? We all know that certain groups of people were overlooked in this globalized world over the last couple of decades, and that should be corrected as much as possible. Although you could argue some of these jobs that were lost were going to be lost no matter what to technology, but that's a whole different conversation. And so, but it's sad to see the world order being kind of upended like that in a way that is not very tactful. But I'm sure there's a strategy to it. Maybe it will all be revealed someday. And
it's fine to have that view politically. Any view in this day and age is fine. And if you don't call it fine, then you're going to be canceled or whatever. But my job and your job is to get the market right. It's not to get their politics right. Again, I'm not a Republican or a Democrat. I'm a Canadian. He's of Dutch descent. I mean, it's just not. It's just the world is voting. It's amazing to watch. The global currency market vote every single day. Oil vote every day. Down, right? Like, I mean, and then the schizophrenic, uniquely American, what I call the mother of all bubbles in the Mag 7, do what it's doing, which is different on many days, which is great. Like, if you're active and you have that non-60-40 go anywhere strategy, I actually think it's becoming a pretty good place to invest all of a sudden. Rick Reeder, I think the other day, who I got a lot of respect for, just like you. I mean, again, you guys are buy-siders who are tasked with global macro and all asset classes. I mean, he's like, this is one of the best trading environments for bonds I've ever seen, because they're just trading, in a choppy range. You can buy low and sell high. So I'm actually pretty constructive on, provided that you don't have what I affectionately call the old wall 60-40 strategy.
Yeah, no, I agree. It's an opportunity. It's an opportunity for a more active investment strategy rather than just being passive, sitting in the beta. And it's our job to kind of detach from the noise and take a step back, peel the onion, and say, okay, this is how we approach this without emotions being the primary driver. And I think that's always important, is to just be as detached as possible, not disengaged, but just detached. It's like the same in life. Like, if you can have a little voice that's over here that is watching you, taking action and correcting it when needed. We all need that little extra voice there saying, okay, don't do something stupid by selling the lows, that sort of thing.
Yeah, someone once said or wrote a book about it. You have two wolves inside your head, and it's the one that you feed that's going to win.
Yes.
And in many cases, like, again, that's probably the most important lesson of experience, I'd say, for you and I, because you and I have made every mistake I think you could possibly make. I mean, collectively at least. I probably made 90% of those, but you get patience. You get the reduction of emotion, which gives you more patience. There's going to be plenty of opportunity to buy and sell things. I mean, look at the wonderful opportunity we just got to buy Bitcoin down double digits versus where it was. It's not like you're not going to get your chance. If you think you're not going to get your chance, then you're going to get an education. So that's that's a good thing that you and I have that's born out of experience. But thank you for having another conversation with me. I very much appreciate it, and I'm sure the audience does too.
Great. Well, thank you very much for having me. It's been a pleasure. We'll do it again soon.
Awesome. Now, if I were to have the experience of riding one of those bikes for a long period of time with Jurrien, you may not see me again. I may not survive that. Okay. The guy's great. Thanks for engaging with not only that conversation but our community, and happy to get any feedback that you might have.